What if I told you false breakouts are one of the most common ways traders lose money? They see price break a high, enter the trade expecting it to go up, and unfortunately, price does exactly the opposite. If only there's a way to avoid these false breakouts completely, to make sure this never happens to you again, or even better, know when they are about to happen. Well, actually, there is a way. With this technique, you will not only be able to know when these false breakouts are about to happen, but you will also be able to take advantage of them for high probability moves. Now, I just released my Telegram. I share all the plays I'm watching, useful trading tips, and a ton of value. The best part is it's completely free to join. If you want to check it out, I'll leave it in the pinned comment. A very common setup you will see is this, where price moves and creates a high. The specific point we are going to be focusing on is the break of this high. Now, there are two scenarios that can happen. Scenario 1, price breaks the high and closes above the high. Scenario 2, price breaks the high and just wicks above the high and ends up closing beneath it. If scenario 2 happens, where the candle breaks the high but closes beneath it, this is what's called a
fake out.
How we know this is a fake out is because price rose above the high and left behind a large upper wick. What this is showing us is that buyers attempted to go higher, but then an influx of sellers stepped in and got the price back down, which, if this happens, especially at a high, there's a high probability chance that we could get more confluences for a trade to the downside. But what happens if price closes above the high? If price closes above the high, this is now considered
a breakout.
Now, you might be thinking to yourself, well, if the other scenario was quote unquote a bad scenario, this scenario must mean price will move higher. Which, what I see a lot of people do is enter long trades as soon as they see this candle close above the recent high, expecting it to keep heading upwards. Which, if you are doing this, it's one of the worst mistakes you can possibly make. You see, if you're entering right here, your risk to reward is going to be absolutely trash. Because where are you going to place your stop loss? You could place it below this low, but then your stop loss is going to be so massive, and if you do get a losing trade, you're going to take a big hit. Yeah, you could make your stop loss smaller, but just because price breaks this high doesn't exactly mean it's going to keep shooting up directly from here. So you have a major problem. While yes, price closing above a high does give bullish tendencies, it doesn't exactly mean you should enter right away. Which brings me to one of the best words of advice I can possibly give you. If you want price to go higher, you actually want price to go lower first. If you want price to go lower, you want price to go higher first. Once you understand this concept, your trading will change forever. So going back to our scenarios, if price breaks the high but just wicks above it and closes beneath it, this is indeed a fake out. But we don't want to just enter a short trade immediately. We first want price to come up first, get a better entry, then enter. Same thing with the opposite scenario. If price breaks the previous high but closes above it, this is indeed a breakout, but we don't want to enter a long trade immediately. We want price to come back down first, get a better entry, then enter. So now you know the difference between a breakout and a fake out, and we can start reading the markets a lot better. But not only that, we can combine the two to get some scary good results. Here's what I mean. So here we have an uptrend. We have our low right here, we have our high right here. Now, price can do anything here. We're not trying to predict price, we're trying to read it. Price ends up going lower. While going lower, it does end up breaking this low. Now, this is the point we need to start paying close attention. If we look closely while doing this, it didn't close below it. It just wicked beneath it, which shows us that sellers try to push price beneath this low, but buyers stepped in and fought them off at this level, which shows us this is not a breakout, but a fake out. But this in itself is not enough reasoning for us to enter just quite yet. So let's keep watching. After doing this, price starts heading upwards, backing up the idea the fake out is starting to take effect. As it goes up, it starts heading towards this recent high. As price crosses this high, it does something that backs our thesis even more. While doing this this break, the candle closed above the high, which would be considered a breakout. So now we have two confluences. We have our fake out to the downside, then we have a breakout to the upside, both showing signs of wanting to go up. Here we have a different scenario. Price made both a high and a low, but this time price moves upwards first. While moving upwards, it breaks this recent high. While doing so, it crossed the high, but it just wicked above it and ended up closing beneath it, showing buyers tried to go up, but sellers took control and brought the price back down. After doing this, price starts heading lower, backing up the idea the fake out is taking effect. While moving lower, it breaks the recent low. Not only did it break it, it closed beneath it, giving us a breakout to the downside. We have our fake out to the upside, our breakout to the downside, which can give us the idea there's a great chance for a downwards move, which is exactly what happens. So now you understand the difference between a breakout and a fake out and understand how to use them together. But there's still a problem. Say if you do get a fake out, then directly after get a breakout. If you entered as soon as the breakout happens, we still have the same problem that I mentioned before. Where will you put your stop loss? Sure, you could put it here, but then your risk to reward is not really the best, because if you do get a losing trade, your loss will still be pretty significant. So we need a way to not only make our stop loss smaller so our losses are smaller, but we also need a way to make our wins bigger. And in order to do that, we need to get a better entry. To do this, go to TradingView. If you don't yet have it, I'll leave a link in the description. Go to your chart, grab the Fibonacci retracement tool on the left, place it on your chart. Next, go to the settings of the Fibonacci, make the values 0, 0.706, 0.618, 1, and 0.79. This will leave us with three main levels that look like this. These levels are what's called the golden zone, or where price has the highest probability of pulling back to and reversing, which, if you're thinking like I'm thinking, we can use this to our advantage. Here, price moves and creates a high and a low. It ends up breaking our low. We look closely and it just wicked beneath it, showing buyers are stepping in at this level, leaving behind a fake out to the downside. After doing so, it starts rising back up, backing up the idea the fake out is taking effect. While doing so, it breaks the previous high. Not only that, it closed above it. Once this happens, grab your Fibonacci tool, mark from the fake out to the breakout. This will leave behind our golden zone. Price starts coming down and enters into our golden zone. Now you are not entering at the breakout, you let price come down first into our golden zone, so you get a way better entry. Now you can place your stop loss below the low, which is smaller than before. Set your take profits at the high, and then finally just watch the play out. Boom. Easy winning trade. Hopefully I got the idea in your head that you not only need a breakout, but you need a fake out alongside with it. On top of that, let price retrace back down before entering. Once you do that, your trading will change forever. Thanks for watching. I'll be posting some of my trade ideas inside my Telegram. See you in there.